Hello, everyone. My name is Antonio Fatas, and on behalf of Takeo Oshii and myself as program directors of the International Macroeconomics Money and Banking track, I would like to welcome everyone to the ABFER 8th annual edition or annual conference. Now, all the hard work to put together this conference has been done by the conference organizers, so I'm going to pass it to them, Helen Popper and Ippei Fujiwara. Thank you.
Thanks a lot. It's really great to see everyone. Wish you were in Singapore, but it's nice to see everyone attending. You may have noticed from the ABFER program that the International Macro track is arranged a little differently from the other conference tracks. We've split all the macro track sections, except for the final joint session with SIBRA, into two back-to-back sessions. So in keeping with that pattern, this morning's session, or evening for some of us, is split into two closely related sessions, and I hope you'll be able to stay for all four papers. Chris Meisner from UC Davis will chair the first semi-session, and Alessandro Rabucci from Johns Hopkins will chair the second. So with that, let me just turn it over to Chris. Thanks you all very much.
Okay, so thank you. So welcome to the first session. We have two papers. Just a reminder for participants to write your questions in the chat room, and we will either read them or co-authors will respond to them on the fly. We have 15 minutes per paper, 15 for discussion, and 15 for Q&A. So our first paper is by Steve Wu, Original Sin Redux. So go ahead, Steve.
So thank you very much for coming, and I would like to thank you, the conference organizer, for putting this paper into the program. This is a joint work with Boris, Hofmann, and Nikhil, Patel. Both of them are from the BIS, so the usual BIS disclaimer applies. I'm Steve Wu. I'm a postdoc at UBC, and I will be joining UC San Diego Department of Economics in the fall. So this is a project motivated by the original sin, which is a phenomenon that in many emerging countries, they can only borrow from abroad in foreign currency. Historically, it was a big issue for many emerging countries that lead up to Asian financial crisis or Argentina sovereign default crisis, borrowing in foreign currency. But since 10, 15 years ago, there is a great escape from original sin. Many countries now can issue debt in local currency. Here, I'm just using Brazil and Mexico as an example. Roughly 5% of their total external debt are in local currency back in 2005. But fast forward to 2018, you see roughly 40% of the debt are in local currency. So they have made significant progress, and the question is the problem solved? In a public media article by Carson and Shin, they argue that that would lead to another problem, that the currency mismatch problem now is migrating from the borrower side to the lender side, and they call this the original sin redux problem. The idea is based on the observation that in emerging countries, oftentimes when the yield goes up, it's also the period when local currency depreciate, or when the yield goes down, it's the period when local currency appreciate. So these investors who care about dollar return, when they invest in peso, when they invest in other currencies, they're having double gain or double loss. So they either gain on the bond return and then exchange rate, or loss together. So this, in this paper, we demonstrate this original sin redux problem in a two-country New Keynesian DSGE model. With a full model, we are able to study broader macro responses and outline some policy implications. Also, with a two-country model, we will be able to show actually the key problem for this original sin redux is that the degree of financial friction for the foreign lender. If the foreign lender are not financially constrained, local currency debt will lead to original sin redemption. So this is consistent with a conventional wisdom that local currency debt is great. If the foreign lender are under financial constraint, which we think is a more empirically relevant case, the local currency external debt will lead to original sin redux, and the responses to foreign shocks are very much like original sin. We'll study two policy implications. We'll see domestic investor base and foreign exchange intervention. both of them can mitigate the implication of original sin redux. And we show some empirical evidence to support these statements. So for the rest of the 10 minutes or so, I'm going to show you very briefly the empirical result, and then we will see in diagram the model setup, and we will understand the model through some impulse responses. So we provide 3 sets of empirical evidence. First, we will show there's a fall in original sin. There are more local currency external debt these days in emerging country. On the sovereign side, this is more well documented. And we are showing this is also true in emerging country corporate sector. Recently, we hear something called indirect bank credit. So using some confidential BIS data, we show that corporate loans to emerging market firms for example, by HSBC Mexico City, but the ultimate source of the funding is from HSBC London. This type of loan are now getting more and more likely denominated in local currency. We also show that global financial friction matter for the local currency spread. In a panel regression, we show that local currency spread is low when foreign participation of local currency debt is high. However, the local currency spread tend to be high when global financial friction by different proxy measured by different proxy is high. Especially the local currency spread is particularly high when both of them, when the global financial friction is high and foreign participation of local currency debt is high. So that means foreign participation is like a double-edged sword. During good times, foreign participation lower the spread, but in bad times when global financial friction is high, foreign participation even amplify the global financial friction. And the third empirical finding is that using a panel regression, we document original sin and redux have very similar dynamics. We show that upon a monetary tightening shock, foreign tightening shock, countries with higher foreign currency external debt will have a larger contraction than countries with low external debt. Country with higher local currency external debt will also have a larger contraction, but smaller in magnitude. And we will see this similarly in the model. So this is the model setup, a subset of the model setup. The left-hand side is the emerging country. The right-hand side is the advanced economy. The advanced economy have a household, and these households, they make deposit into the banks. These deposits are in dollars. And the banks, they make loans to emerging country. These loans are in foreign currency, are in dollars. Further, emerging country, they do business in peso, or they make further loans to their own economy in peso. So this is the standard original sin problem that if you look at this banking sector, they are getting loans in dollar and they are making loans in peso. So there's a currency mismatch here. On this slide, I showed the only difference compared to last one is that we changed this dollar loan to now peso loan. And this is what we call original sin redemption, because now if you look at the left-hand side, here everything is in peso, so there's no currency mismatch problem. So if you look at just the emerging economy, this is a good situation that you are not subject to exchange rate volatility via the financial channel. The original sin redux problem focus more on the right-hand side. When these banks, they are getting deposit in dollars, but they are making loans in peso. Then there's currency mismatch problem here, especially if these banks are also under financial constraint, like leverage constraint in Gertler Karate. We would have this in our model. Then exchange rate movement or currency mismatch is going to amplify the financial friction and leading to changes in net worth and lending capacity. So this is the full model we have. The additional ingredient is just adding the production sector properly. But the special case that we will consider is that we will have household in emerging country. They can directly put domestic deposit into their banks. We will also consider a central bank that can do FX intervention. In the paper, we also have sovereign, so we can talk about original sin redux both for the public debt and private debt. So I'm going to show you some impulse responses. The impulse would be advanced economy monetary tightening shock. So it's a 1% increase in foreign interest rate. We'll compare the impulse responses for original sin, so the foreign currency debt case, and original sin redux, the local currency debt case. We'll compare this across different cases when there's no advanced economy financial friction, when there's some advanced economy financial friction, and policy implication of domestic deposit and FX intervention. So here is the case when there is no advanced economy financial friction. So all these blue lines are the line for original sin case. That means the debt are in foreign currency. 100% monetary tightening is going to depreciate the currency. So here you can see the exchange rate depreciate. Positive means depreciation. Depreciation of the exchange rate lead to sharp contraction of banking net worth because they are borrowing in dollars. Now, because of the reduction in banking net worth, that lead to substantial reduction in emerging market investment and also emerging market GDP. So this is the standard original sin problem that foreign currency debt lead to sharp contraction upon exchange rate depreciation. Now this picture, the blue line is just the blue line we have seen. And then the red line is the case when we have local currency debt. Still, we are under no advanced economy financial friction. We can see that with local currency debt, the exchange rate depreciation doesn't change the net worth of the bank that much. So the net worth of the bank is substantially not affected. But then you can see here on the right-hand side, the advanced economy banking net worth is affected stronger than before because of the exchange rate mismatch problem. However, since there's no financial friction for the advanced economy, their banking net worth is actually an irrelevant state variable. So you can see that in this case, when you have local currency debt, emerging market investment is less affected and emerging market GDP is also less affected. So this is what we call original sin redemption, that the usual policy suggestion of advocating local currency debt is a great idea that can isolate shocks from the foreign economy. Here I'm looking at the case when there is advanced economy financial friction. Now in this case, you can see that the depreciation is going to lead to sharp contraction for the emerging market banking net worth if the debt is in foreign currency. And it's going to affect, again, the advanced economy banking net worth if the debt is in local currency. Since the advanced economy is also under financial friction, either case you have the EM bank suffer or the advanced economy bank suffers. And so that either case, you see the emerging market borrowing rate goes up quite substantially. And therefore, no matter you borrow in foreign currency or local currency, you see sharp reduction in EM investment and sharp reduction in EM GDP. So this is what we call the original sin redux. The usual policy suggestion of advocating local currency debt may not be that ideal or that important in isolating foreign shocks. So here we are now considering the case when there's direct domestic deposit from domestic household. The blue line and the red line are foreign currency, local currency that we have seen before. Here I'm on top of local currency. I'm having 50% of the debt in domestic deposits. So this is the DD case. We see with domestic deposit, the emerging market banking net worth is less affected when there's a interest rate shock. And that leads to a smaller drop in emerging market investment and smaller drop in emerging market GDP. The idea of why domestic investor helps is that intrinsically, domestic investors are evaluating currency return in local currency. So there's no exchange rate mismatch problem there. Also, by construction, we are assuming the household, they directly put deposit into the domestic banks. So the financial intermediation does not go through the financially constrained global banking sector. So that get rid of one layer of financial friction than before. Finally, we look at the case of...
One more minute.
Yep,
one more
sure.
minute. Yeah,
Yep.
thank you.
Finally, we look at the case when there's FX intervention. So these are sterilized intervention. The blue line are no FX case, FXI case, no intervention case. The red line are the sterilized bonds going to the household sector. And the orange line is the sterilized bond going to the banking sector. Here we see the red line and blue line overlap almost everywhere because the household are financially unconstrained. And so FX intervention has not much effect because it's going to be undue by the household. These are classic no FX intervention effect in the models. We show that if you have FX intervention to the targeted sector, to the banking sector, then the net worth is reduced less, and therefore the investment is reducing less, and therefore smaller drop in GDP. So intervention to constrain the sector could help improve the situation. So just to conclude, we show that original sin at work in the DHE model. We show that local currency debt may not be a perfect cure for isolating shocks. And the key to understand the difference is original sin or original sin redux is the degree of financial friction for the foreign lenders. We show some short-term policy like FX intervention to constrain the sector may help. Long-term policy of investing domestic investor base could also help. Thank you very much, and looking forward to the discussion and questions.
Fantastic. Thank you for that, Steve. Now we have comments from Linda Tesar.
So I think Steve did a great job explaining the paper. I really enjoyed the opportunity to read it, and I learned something from it, and it got me thinking hard about some things. And so I appreciate that opportunity. So Steve already explained this, but just to kind of click ideas into place, the comparison here is between a world with original sin borrowing and what's been called the original sin redux. So what does that mean? Well, we're thinking about this from the perspective of the emerging market borrower. And the original sin is that for some reason, low credit worthiness, there's a perceived high risk of depreciation, that the borrower is unable to borrow in their own currency and has to borrow in either dollars if it's a US bank or pounds from a UK bank, but they can't borrow in their own currency. They have to borrow in a large advanced economy currency. And that requires, of course, the borrower to carry the foreign exchange risk. And as well known, lots of papers have shown in the literature that in the event of a surprise monetary tightening in the United States, this results in capital outflows from the emerging market and large negative spillovers to emerging markets. So this is the original sin problem. So then, as Steve points out, well, as time has gone on, more emerging markets have been able to borrow in their own currency. And so this shifts, to the extent there is a currency mismatch, it shifts it from the borrower to the lender. So now the advanced economy banks are carrying this foreign exchange risk. And what this model does is it says, well, if those banks have some financial frictions, then they might run into situations where they can't handle this shock. And so that these constraints become binding. And now you have a negative spillover coming from that channel. And the policy implications here, which I'll come back to, are one way out of this would be to have more domestic savers providing capital or loans to the firms, and then you wouldn't have an exchange rate problem at all. Or foreign exchange intervention is also potentially helpful. So let me start first by talking about the empirical evidence that is discussed in the paper. In 15 minutes, Steve doesn't have a lot of time to go through the details. So I'm just going to hit, and neither do I. So I'm going to hit a couple of high points here. What we're looking at is a U.S. money surprise. And so this takes markets by surprise, and there's suddenly higher interest rates. And there is a literature on this, and in fact, this paper cites this Banerjee, Devereaux, and Lombardo paper And they look at a very similar set of countries, similar kind of shock, the surprise money shock, and they show that in the event of this event, real GDP declines. This is in the emerging market. There's a foreign exchange depreciation. There's a temporary increase in the nominal interest rate and capital outflows. So what this paper emphasizes is that real investment declines, and that's not surprising given that we know that real GDP tends to decline. But the point that they emphasize is that this decline in GDP is larger if you have this original sin problem. If you're a country that has tended to borrow more in foreign currency, i.e. the currency of the advanced economy, as opposed to your own currency. And they also show that there's no effect for advanced economies in this situation of a surprise monetary tightening. So both papers confirm that there's this negative transmission of a U.S. monetary contraction from the United States to emerging markets. The point of this paper is that the transmission is weaker if you're borrowing in your own local currency. So I think it would be nice to see this effect fleshed out in more detail. So there's really one set of regressions, and there are some controls thrown in. It's not explained in a lot of detail, but I think this needs to be really convincing. I think more work here is needed. So, this tightening of U.S. monetary policy, it's exogenous from the perspective of the emerging market. But of course, it's not a surprise to the monetary authority in the United States that has decided that this is a time to change interest rates. So this is a signal that something has shifted, and that signal is probably correlated with economic activity in the world that's important for the United States. It's also probably economic activity that's going to be important for the emerging market. So I think there need to be controls here so that we're sure we're picking up this money surprise and not the signal that's coming from the money surprise for other economic activity. The other thing is the denomination of these loans is an endogenous variable. That's a choice, whether a bank, how it prices, what kind of interest rate it charges for borrowing in local currency versus borrowing in US dollars. And I think the paper could do more to make it clear that this isn't correlated with other things that might be true about these particular countries. Like, to what extent is that portfolio of foreign currency denominated loans to local currency denominated loans, is that related to how much trade there is? Is that related to whether there are multinationals in the country? What's the supply chain situation? How much vertical integration is there? How big is the country? I think some of those things are probably in there. It's just not really fleshed out. So it left me feeling like I wanted to know more. Now, ideally, we'd like to have like a natural experiment where we have the same country borrowing and there's some exogenous just flip of a switch that says, yep, you get this kind of loan instead of that kind of a loan. We don't live in that kind of a world. And because we don't, we either need to find some kind of instrument, and in the absence of an instrument, we need a really full set of controls to make this really convincing, I think. The other thing, so this paper shows that local currency lending has gone up, and it's that going up is from the perspective of the emerging market. But we really have to think about how much has that gone up from the perspective of global banks. Like, do they really feel that they are facing a significant amount of risk that's going to be hard for them to manage as this currency risk has shifted from emerging markets to these advanced economies? And someone put in the chat, I think Alessandra put in the chat, well, what about hedging? And that was my question too. I mean, you have to show that these banks really do have their backs against the wall and that they don't have other opportunities for managing this exchange rate risk. So for this credit channel to be important, we need to show that this foreign exchange depreciation in emerging markets is going to be a large enough risk to affect the balance sheet and affect it enough that it affects the bank's net worth. And then that leads to these subsequent knock-on effects. So, we also have to show that this effect is not just like, if emerging market exchange rates don't move at the same time, that's another form of hedging, right? So it's got to be like these exchange rates have to move in the same direction and have to really increase risk for these global banks. That may be the case. I'm just saying that I think I needed a little more convincing as I was reading the paper that was true. Let me turn now quickly to the model and some of the results. So the model is really closely related to this Banerjee et al. Paper, and the authors are clear that it is related to that paper. They cite the paper. And the contribution of this paper is to add a constraint on those domestic deposits and also adding this lending in local currency channel. Now, I'm going to call it BDL, Banerjee et al., they show that with financial frictions, a monetary tightening in advanced economies leads to this decline in bankers' net worth in the center country. I mean, they show it in their model. And this amplifies the fall in investment. So that result is already out there. So the result that this paper is going after is, well, to what extent is that effect mitigated by having some lending in local currency? And actually, they do a special case in their paper where they show that under local currency denomination of liabilities, the transmission effect is lessened. The fall in investment in GDP is reduced by about 30%. So I think, the thrust of the findings of this paper are kind of in Banerjee et al., unless I've misread either of the papers. But I think the value added of this paper could be a really tight calibration of the model to actual exposure. So rather than taking kind of off-the-shelf parameters, actually maybe even try to estimate the steady state of the model so that we really feel like we're getting a quantified magnitude of the size of this effect. If it were me, that is the direction I'd recommend. Just have 3 more comments and then I'll wrap up. I also think the paper sets up a little bit of a straw man baseline, and it's not just this paper. I think it's kind of out there in the literature. But there's this statement that, well, to what extent can borrowing in local currency kind of insulate an emerging market? Like, do we get home free? Have we graduated from original sin and now we're insulated from shocks? Well, countries are never going to be fully insulated from shocks. And in fact, if they're trading with each other and there's foreign direct investment, and in fact, if there's risk sharing, things are going to be correlated across countries. So I think that's a little bit of I'm just kind of wondering, what benchmark are we going for here? And conditional on what would we say they're fully protected from shocks? I also think it would be nice to have a little more nuance in the discussion of this financial friction. So the model imposes an incentive constraint on banks, but you could imagine other kinds of constraints, like a value at risk constraint, or other ways of bringing in this financial friction. And it's just an open question. Does it make a difference how that's modeled? I just wasn't sure. And then finally, it was a little hard to know what to do with a policy prescription that says, well, we should just borrow more from our own savers in our economy, and that would make things better. But of course, I don't know what the policymaker can do. That's kind of a hard lever for them to move. Like, let's have more savings in the local economy. I mean, after all, they're borrowing from abroad because local investment demand exceeds the supply of savings. That's why there's capital inflows. So yeah, if we could cut down on capital inflows by saving more at home, that would mitigate this problem. But that's kind of the situation the emerging market is in. So I just wasn't sure exactly what to make of that policy lever. So finally, just to sum up, I think this is a really interesting paper on it's an important subject. The paper I think this is its first round, and I think there's a lot the authors can do to make the empirical story more convincing. I think there's things that can be done with the model to help differentiate it from BDL. And I'm really looking forward to seeing where this paper goes. So thank you very much.
Thanks for the comments, Linda. There's now 3 questions in the chat room. I don't know if Steve's been able to follow. They're all from panelists. So you're able to ask the question if you want. If you want to unmute. I think Alessandro had the first question.
Nice presentation, and I like the paper. So I'm not sure whether original sin is the right characterization. Here it seems to me that we are looking at a different type of balance sheet exposure. What Hofmann and company meant when they coined that term is the impossibility for the emerging market to issue in their own currency for lack of credibility for an history of monetary instability, either domestically or abroad. Similarly, today it's still very expensive for emerging market banks to hedge. That's why they are prohibited to have exposure. But it's very different from Citibank New York, which can certainly hedge any type of exposure. So I wonder here whether it's really a comparison of different balance sheet exposure as opposed to addressing the question of the original sin. And my reading of Yeung and Augustine's contribution that you're referring to was that they have in mind the government bond market, and they have in mind the mandate constraint on U.S. pension funds, which in a sense is in that nature. So they are in the U.S. they are mandated to have a certain foreign exchange composition, and that is implication for the local government bond market.
Thank you very much, Linda, for the great discussion. I think there are many interesting points that you point out. So it would be great if we can have your slides later. We can follow up on this. So the very first question by Linda and also by Alexandro is a problem of hedging. We have to admit that we lack of data to confidently say how much of them are not hedging, how much of them are hedging. But we are here talking about a larger set of, I would say, financial intermediary, not just banks. So for example, for some mutual fund or just investor in general, there may be not that amount of regulation that require them to directly hedging every single exposure. And also even for banks, not all the jurisdiction require a full hedging for their business. And many of these banks are doing something called dynamic hedging. So they're hedging day to day. And if there's some small fluctuation, I think those hedging is fine. But they are not hedged up to like big exchange rate movement. And so if regulators are not asking them to hedging all the exposure, many banks are just doing the like minimal hedging that regulator requires. I think in terms of the differentiation in the model with Banerjee, Lombardo, we think we definitely inspired by their model and view on it. So now we have the sovereign sector and on top of what they have, and also we consider some policy implication from that. I guess one highlight we are showing is also actually it's not the it's true that local currency, foreign currency, they have similar impulse response, but if you turn off the financial friction for the advanced economy, then they will have very different response. So it's really the financial friction for the advanced economy that is matter, at least in the model. And in the model, we are going to a bit of extreme case that everything is unhedged, but yeah, so that would be the extreme case. Thank you very much.
So I think Mark Spiegel had a question in the chat room. You want to?
Yeah, thanks. So I was also thinking about, this question of hedging in Alessandro's, and I thought, well, the only story you could really tell for these large, global banks is a surprise on the advanced economy side, like a taper tantrum type of episode where there's a rise in advanced economy rates all across the board and they lose money on all of their foreign exposure or something like that. But then I was thinking, that raises the question, there's a special issue which you didn't consider, which is fine, but maybe it's worth thinking about in terms of the applicability to the current situation of the zero lower bound, because it's well documented that in the neighborhood of zero lower bound, certainly at the Federal Reserve, all the banks complain, and they're really, their profitability goes way down whenever there's lowering of interest rates because they can't pay negative rates on deposits. And so because of that problem, this surprise interest rate increase would be bad news for their foreign lending exposure, but it would actually be immediately hedged by the fact that it's a good news surprise for their net interest margins domestically, because of the fact that all their deposit rates were constrained, but their lending rates go up. So maybe the effect. I guess the bottom line is it's not. We would want to see more empirical evidence that this effect is really big.
Okay, thank you, Mark. I think that's a excellent point, and I totally agree with you. I mean, when we're talking about hedging, one thing that we cannot hedge is kind of some aggregate risk that cannot be hedged away, and so a general dollar appreciation is something that at the back of our mind that you cannot hedge those away, and so this is aggregate risk of exchange rate, and that would be not good for the global banks, and that's documented by some paper by Xin or by Wenxin Du on dollar exchange rate and also profitability or net worth of the banks. On the zero lower bound case, of course, we don't have that in the model, but I think that would amplify what we are saying, because if the global banks are doing, portfolio choice on what to invest foreign or invest in domestic, tightening shock that increases the returns of investing domestically will further shift their portfolio from the foreign to the domestic, and therefore there will be even larger capital outflow. So reduction in lending capacity to foreign economy would be even less. So then in that case, originally seen Redux could be even worse than what we think. Yeah.
Helen Popper had a question next.
Yeah, so I was just a little surprised by some of the discussion of the foreign exchange intervention. And I wondered if you could talk a little bit about sort of what model of intervention you have in mind and how the central bank in your model goes about targeting a particular sector as opposed to, exchange rates or, changing the money supply.
Oh, okay. Yeah, so we are, I think the particular FX intervention that we are thinking is related to some recent literature, for example, by Roberto Chang or by David Stavro Yu recent paper. So the idea of these FX intervention is related to like large scale asset purchase. So by using the the reserve, they can swap the portfolio and buying domestic bonds. So in that case, they are buying domestic bonds from the in our model, buying domestic bonds of the constrained banks or financial sectors. So that helps them to bump up the net worth and increase the lending capacity.
Thank you.
There's one other question from Ipe Fujiwara.
Okay, thank you very much. So I agree to lender. It would be great if you could test your IR result with the natural experiment. So that, do you have any good cases in your mind where you can test, say, using a local projection and a conditional on the FC or a local currency borrowing with the controls for the factors that leads to the LC or FC borrowing? And I thought that the technique like a propensity score matching may be useful. So you are controlling how likely that each country is using the LC funding or FC funding. Then, if you could show such kind of result, then your model, I think, your model conclusion seems to be more convincing.
Okay, thank you. Yeah, I think we need to think more about that, teasing that out from the data. I think that's also what Linda suggested. So yeah, relatedly, we are not able to fully flesh out the endogenous choice of currency here, largely because we are using a linearized model, so there are no like risk trade-off between currency. But here we are, so the experiment that we are doing is fixing the currency. What's the implication upon some shocks? So in that sense, I think this is still a valid experiment that conditional on the exposure that you have, what's the implication of those original sin Redux. But what's the reason of endogenously forming this portfolio? I think we still need to think about how to sort that out in the data or in the model. Thank you.
Thank you.
So there's no more questions. I'll take the opportunity to ask a question as chair. So this is really interesting. One thing I would like to know and hear about is here you talk about how trade patterns matter, like a natural hedge. I gather you only have 2 countries in your model, and in the real world, you might have some offsets with other trade partners, and that could matter a lot for your empirics, but it would be interesting in the model too. So I want to hear you talk how you dealt with that.
Yeah, so I actually have some related paper on this, and also I think some papers in the literature has documented this. Actually, a lot of the firms that are now borrowing in foreign currency, they are not the firms that are having large trade exposure. So in emerging countries, you can think of actually some construction or real estate firms that are pretty domestic firms. They are borrowing a lot in foreign currency, making kind of like a carry trade behavior or taking advantage of the low interest rate. So in that case, in the data, we see very limited operational hedge. And even using FX derivative, I think a recent paper shows that for large set of Peruvian firms, these FX exposure are only, FX derivative are only used by very, very large firms rather than small firms. So thank you very much for all the questions, and we will keep you posted about the paper.